Nimesh Chandan is here with us today to talk more about markets. Nimesh, how are you analyzing the market landscape right now? What's your approach? There have been a lot of brokerages which have been upgrading earnings as well as frontline index targets. But keeping that aside, what's your own hypothesis for the market for the next 12 months or plus?
Hi Ajay, it's always nice to be on your show. At this point of time, my view is that we are actually pricing in most of the positive developments that the market was expecting. Whether it is stimulus packages, whether it is election results, whether it is vaccine, all these events had certain leading indicators or rumors about it. So none of them are black swan. They have been talked about. Yes, the timing being a little early or results being a little better for the vaccine does give some confidence in that the path that we were expecting is right. But once the market prices in the good news, then you become vulnerable for any disappointment that can come. Right now, market is very buoyant. We've seen a fantastic rally in the markets. But here on, I think investors need to keep a certain check and be more patient now for returns from here, because you have to be more calibrated in your expectations after the market has given such fantastic returns in 9 months. And mind you, market has reacted before a positive news or positive data has come in, which means the correction can also come in before the whole set of disappointing data or anything that on the horizon can come. So right now, I think a positive news are coming in, but they are also getting priced in very quickly. So from here on, investors need to be a little more careful and plan slightly longer term than what we are doing right now. So returns may be more moderated from here going forward, at least in the near to medium term.
Moderate. Fair point. Nimesh, completely point taken. I mean, the way markets have rallied and they are kind of working a little ahead of what the earnings could be. Let's talk about pure earnings. And I'm talking about frontline indices only for illustrative purposes. The broader indices or even collection of stocks, say for example, the fund which you're manning, the earnings profile may be even higher than the frontline indices. But the view is that there could be up to 25% earnings upgrade for frontline index for the next 1 year, around 14-50% for the year next. What kind of earnings or improved earnings outlook do you have of your own portfolio? Does it mirror the environment? What kind of chats you had with your promoters of these companies you're holding?
So as a fund house, we are more tilted towards quality and growth. So naturally in our portfolios, we have companies that generally have better return ratios and better balance sheets than the market average, as well as in terms of growth, we have more skew towards higher growth companies and companies that can sustain that higher growth compared to the overall market. Now, because of this, if we see our portfolios, they have done extremely well, and a lot of it was because of the companies that we selected. Now, going forward, already the market is pricing in a 40 to 50% jump in overall earnings for FY23, FY22 over 21. But 21 has not been so disappointing in terms of earnings as what market expects. So there are some upgrades that came in Q1. There are more upgrades coming in Q2 also. But some of it can also get moderated. For example, if something is, some companies are already getting the benefit of better margins due to a tight cost control, cutting their discretionary spends in terms of ad spends or any other discretionary item, that may not be replicated when things are normal again, when things are back to normal. Plus, the valuations are already pricing in a lot of this margin expansion that has come in. FY22 is already expected by the market to be a normal year. with the vaccine coming in, there are hopes that we will quickly get rid of this COVID issue and things will be back. But unfortunately, I mean, we still don't know the timelines by which the vaccines will be distributed, by what time we will see the full immunization against COVID, and when people will be back to normal. This winter is quite harsh in some of the countries where the COVID cases are actually rising very, very quickly. So that's one part of it. The other part of it also, people tend to extrapolate good data into the future and expectations go high. All I'm saying is when expectations are high and they are priced in, there is a scope or there is a vulnerability towards disappointment. Now, within the whole breakup of corporate aggregate earnings also, there are some sectors which have not seen much impact of COVID and they continue to contribute well to Nifty. So, for example, pharmaceuticals or utilities, you take even IT, which smoothly moved to working from home. So they have not seen a sharp degrowth in earnings in this year. So the growth for next year to normalization may not be as much from that part of the universe. So all I'm saying is we have to be a little more calibrated in our expectations from here. Markets have moved up significantly. I still believe that certain themes that have impacted or given positive returns in this year, like Atmanirbhar Bharat, where we are promoting exports and promoting import substitution, that may do well. Rural India is expected to do well. And we may also see return of inflation coming back, which I had spoken about it last time on your show. We are already seeing that metal prices, commodity prices, even soft commodity prices are moving up significantly. So inflation can come back. So those themes will continue, will contribute to earnings growth, may see superior earnings growth than the average market. But we have to again look at what is being priced in and not. And why I say this, typically after a strong run in the market, investors tend to look either forward like 23 and FY23 and 24, where on the flip side, you have to be that patient because market may not reward that earning growth so quickly. Two, people will look at where they have better expectations than the crowd. So you're taking anti-consensus trades where people try to take contrarian bets or pick up underperforming sectors in expectation that they will perform better. Now, here you have to be very accurate and thorough in your stock picking, in your sectors picking, because you are going against consensus and you have to time it right. The third part I have seen historically in bull markets is that people start playing relative valuation. If a sector has companies which are like 35 to 40 PE and they're getting a stock at 30 PE, people would want to buy that because it's cheap. Now, cheap is very different from being underpriced. So because of a business model, because of the return ratios, because of the leverage in the balance sheet of that company, the company may deserve to be at a lower valuation than their peers on a relative basis. On an intrinsic value basis, they may not be underpricing. So again, here, investors have to be careful, and we ourselves are very conscious that one, when we are looking at contrarian bets, we are very thorough, where we are betting on better expectations. We are patient when we are looking at longer term themes. And third, we have to be very well calibrated when we are looking at underpriced stocks in a bull market where everybody is trying to pick up relative valuation, better valuations.
Right. Very quickly, last question, Nimesh. What is your outlook on mid caps and what themes do you like there in mid caps?
So mid caps and small caps, I'm quite bullish about, and this I've reiterated quite a few times. I think still in this space, which is much lower than its levels in December 2017, there are opportunities for good stock picking here. There are companies that benefit from the themes that I mentioned, which is rural, Atmanirbhar, and inflation. There is a sub theme which I think the sector, the whole category can benefit from, is leadership. In this scenario, when country went through lockdowns, there has been an accelerated movement of business from unorganized to organized. Leaders in the sector have been able to increase market share. So they have been able to raise capital, they have invested in technology, they have improved their distribution, and many of them have good brand strength. So when there is an aspect of that leadership which creates a dominance in the market, which helps leaders increase their market share during this time when the rest of the industry is in trouble. I think that theme will get better returns for investors. And this is something that as a fund house, we are also conscious about.